We've asked Andrew Thrasher, he's the portfolio manager at Financial Enhancement Group, LLC, to come and join us here this morning on the show to discuss why it hasn't, or why we've seen the VIX coming off. Andrew, it's great to have you back. The new all-time highs sent the VIX lower, but it still remains above the April lows. What's keeping it elevated?
Not only is it above the April lows, we're seeing a lot of other measures of volatility have begun to rise as well. To kind of kick things off, I think volatility's bottomed. I think we've seen a low in volatility. Does that necessarily mean we're gonna skyrocket to 50? Absolutely not. But I think we're starting to see some percolation in the volatility market. I think the hedging looks very attractive, and you're starting to see some investors appreciate the high in equities. We're getting some support from breadth, but they're starting to put on a little bit of protection. We're starting to see a little bit of rise in skew, a little bit rise in the VVIX, the volatility index of the VIX. And these are signs suggesting that traders are starting to pick up potentially some hedges.
So, Andrew, are you thinking that we're going to maybe come off the highs here now, or we just don't have enough to really sustain a move into these all-time highs? Because in theory, new all-time highs means lower volatility. Where do you expect this to come from?
Right. So typically, as you said, the correlation between volatility and stocks is historically negative. There are periods of time where we can see volatility rise or at least consolidate while stocks can remain strong.
Okay.
So when evaluating the equity market, looking for signs of deterioration internally, so when it starts seeing less stocks rising, and we started seeing that earlier in kind of early July, late June, but breadth has really started to improve. We've had a good level of stocks trading above their 50-day moving averages, good expanding list of new highs. The biggest concern is, while the markets are at new highs with the Dow, the NASDAQ, the S&P, we're not seeing participation from small caps. And really from an entire risk appetite standpoint, the way we got to these new highs was not from or at least from my opinion, an increase in beta. We're not seeing this raging risk-on mentality of the market. It's really kind of a slow-stepping grind higher, which is, I think, what kind of helps keep maybe some of the volatility from hitting multi-month new lows.
Yeah, Andrew, you touched on the fact that the Russell isn't seeing really the same participation, the new all-time highs along the lines of what we're seeing in terms of the ES, the Dow, and the NASDAQ. We talk a lot about that on the show. We really kind of revert back to rates coming off and the impact that has on some of the smaller regional banks that make up a big part of the Russell. But what are you seeing? I mean, why do you think that small caps have been lagging, as you mentioned?
It's essentially we had this conversation last summer, and kind of going into the fourth quarter, and it was entirely dismissed. And to a degree, the market doesn't require to have small caps participate in a rally higher. But we saw this breakdown to where small caps were not participating, and they were not outperforming large caps into the new highs last year, going into August, September, and it was really heavily dismissed. As a sign that again, you can rely on just a handful of stocks to move the market higher, and that's okay. And we saw what happened there. So if we want to look at market history, when's the last time that we really had the S&P hitting multi-year new highs relative to the Russell 2000 at the same time that the S&P itself is hitting new highs? So put it a different way, when have we seen the market really strong and the small caps not outperform? And the last time we really saw this type of market environment was September 2014 and October 2007. Now, obviously, when we talk about 07, people get nervous. I'm not saying that we're going to have a repeat of 08, but we really haven't seen it very often to where we have this large of a divergence in relative performance. In September 2014, we did see equities pull back for about a month or two. They did have a little bit of consolidation, and then they resumed their uptrend. So I think something like that's very possible. To the point about volatility, I think volatility is very low. I think hedging makes sense here. At the same time, I'm not expecting some market crash or anything like that. The breadth data is just too strong to support that argument.
So you mentioned again one thing I'm watching in terms of, as you mentioned, a handful of stocks that oftentimes are the catalyst is how the FANG stocks have not been participating as well this time around.
Right.
But you did say again that it's not required to see small caps participate, and we're certainly seeing a reflection of that in terms of recent price activity, the new all-time highs without the Russell participating. Now with the U.S. indices though into new all-time highs, we've also seen European indices hovering near all-time highs as well. For example, the DAX and the FTSE, while the stock market may not necessarily be the best indicator as far as the health or well-being of the global economy, it's certainly a reflection that investors are very confident in the future of these companies as they're buying into them.
They have, and I think there's less confidence in the companies. It's more confidence in the Fed and the central banks in Europe.
Noted.
We have, as you had discussed numerous times, the Fed expectation of a rate cut. We're starting to see easing internationally as well. Russia's cut, I believe Australia's cut. ECB has discussed about having some easier policy there. So there's a much more accommodative central banks, not just domestically, but internationally. And so I think there's much more reliance on that than an expectation that companies are printing money themselves.
Yeah, which kind of makes me think it may not be so much an issue of investor sentiment being enough to hold and sustain these upper levels. Maybe it's more an issue of will the Fed and ECB and other central banks continue to provide the rhetoric and the stimulus that's necessary to keep these markets at these upper levels.
Right, and it creates kind of a dichotomy to where the market begins to cheer weakening economic data because they think it's going to bring about an easier Fed. The other side of that coin is we're entering earnings season, and that weaker economic data obviously is going to have a flow through to what corporate earnings are going to do. We have the economic surprise indices are at historically very low levels. And the poor economic data, while it might stimulate the Fed, earnings season could maybe catch us off guard, as the good news is bad news doesn't really play as well with earnings season.
Yeah, in terms of the good news is bad news, I'm curious, Andrew, what stood out this week most in terms of comments from the Fed Chair Jerome Powell?
I watched some of Jerome Powell, but unfortunately that was not one of my main screens. I don't personally pay a lot of attention when he goes before Congress. I don't think Congress, they're reading off note cards prepared by an intern. They don't understand the questions that they're asking. I think he did fine. One thing that was different that I noticed is he released his statement a little bit earlier than normal. I think he really wanted to get his prepared remarks to the market as soon as possible, let them digest that. And I think that was the most important part, was his prepared remarks. And the market took it very well. We saw that we didn't see any major volatility or market moves off that. And then he was able to kind of ride the tightrope through the Q&A, and I don't think he had any issues there either day, the Wednesday or Thursday.
Andrew, really appreciate it. There certainly was a fair amount of political posturing going on, and certainly appreciate you joining us here this morning to help us take a look at some of the recent activity that we've been seeing in the indices and volatility traders. That's Andrew Thrasher. He's the portfolio manager at Financial Enhancement Group, LLC.